So today we're going to go back and take a look at one of our recent trades on Costco. And the reason we did this trade first off was you can see right here, there's this huge drop, and that's because earnings took place right here. So what we did was we waited for the first day to go by after that huge drop, and the very next day we got in. Why? Because down here you see this is volatility, and this is the graph. You can see the green line is kind of where it is on average, and you can see this blue line shows it's kind of well above that. So the second day after earnings, volatility was still really high, and we just figured, hey, it's taken its big drop. Hopefully, it'll settle down from here on in for a while. So that's how we chose to make this trade. When we made this trade, the stock was roughly at $207. So now let's go to the trade page and see how we set this trade up. So you can see the stock price was right around $207 up here. And if you know my rules, you know we try and trade as close to 45 days as possible. So that being said, this would be the expiration cycle we use, because that's 46. That's about as close as we can get. And we decided to set up what we call a chicken iron condor, which is we're going to look to collect roughly half the credit of the width of the strikes. So what does that look like? Well, if the stock is 207, the way it worked out in the end was, I've got the trade set up here, we essentially went $10 away on the put side, down to 197, and $10 away on the call side. So we put the stock as close to the center as we could between our two short or sold strikes. And then again, you can see the iron condor is $2.50 wide. So we were looking to sell for roughly half the width of the strikes. So if the strikes are 250, we're looking to sell it for around 125. And in this case, we did. We sold it for exactly 125. So that's how and why we set up this trade the way we did. So if we go back to the chart the day we put on this trade, now I've put in basically our short strikes. And what this says is if the stock price somewhere in this 46-day window basically stays there over time, we're going to make some money. So when we did this trade, remember the stock was right in the middle at 207, right about here. And we just made a bet that hopefully it stays between these two short strikes over the next 45 days and we can make some money on this trade. That's the trade we set up, and that's why we set it up this way. So now let's follow this trade day by day and see how it played out. So if we go day by day, you see right here, after a couple days, the stock went against us and it went way down. Now, normally speaking, most people get scared out of trades, but because we did a defined risk trade, we know how much we can make, how much we can lose. We don't get scared out of trades. The other thing I want you to be aware of here is why I always choose 45 days or as close to 45 days as I can, because that gives us duration over direction. It essentially gives us time to be right, because very rarely are we right out the gate. And as you can see here, we were totally wrong. The stock continued to go down, 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 down. But we didn't get scared. We hung on to this trade. And we just kept going along. Then you see it came back into our range, which is where we want it to be. Bounced around. And this green square here is when we took off the trade. And why is that? Because that's where we reached roughly 50% of our max profit. And if we go back to the trade page here, I've gone ahead in time to where we took the trade off, which was roughly a month after we put it on. Remember, we put this trade on 12/17. About a month later, you can see it went down, went up, but we managed to close this for a roughly $70 trade, $70 winner. And the reason we take it off at roughly 50% of max profit is it just increases our chance of being successful. When we put this trade on, there was a 50-50 chance roughly of this trade being profitable at expiration. But because we managed it correctly and looked to take it off at around a 50% profit, after about a month, there's still about 2 or 3 weeks left in this trade, but after about a month, we managed to take out over half of the profits, walk away a winner. Obviously, our chances of winning increased dramatically because we took it off earlier than just waiting till expiration, which is another one of our tricks. We always try and manage early. We always look to probably manage these things at roughly 50% of max profit because it increases our chances of being successful on trades. So just a quick recap again. After earnings, the stock took a big dive. We put on the trade the day after while volatility was still high. We were hoping it would stay between these two blue lines. It obviously went against us early on, but because we had time in this trade, duration over direction, we were able to hang on to it and take it off for a big profit right here. If this interests you and you'd like to learn more about trading and how to receive our option alerts, please click on the link below.